So for investors, stocks and bonds are often the most common types of investments people will own. So I was actually just having a conversation with my friend Chris about what are the differences between stocks and bonds. So I thought I'd share that with you today. So my friend Chris calls me and said he just quit his job driving a school bus. It was stressful and he couldn't take it anymore. He tells me he wants to start a business. He said he really likes pizza and has always wanted to open his own shop. I said, great, that would be perfect for you. Have you thought about how much it'll cost to get it going? He said, yeah, it'll probably cost like $50,000, but the problem is I only have like $5,000 saved. I said, well, you could borrow money or issue shares of the new company to other people that might want to invest in your business. I think he understood what I was saying. I'm not sure, but he was really excited at that point. I explained that he could borrow the money by issuing a bond to an investor, and then he would have to pay them interest on the money he borrows. For example, if he borrows $45,000, a bond investor may require Chris to pay them 7% per year for the duration of the bond. In the example we're looking at, it's a 5-year bond. Then, at the end of the 5 years, Chris would have to pay back the full $45,000. Now, the bondholder isn't an owner in his business, but if Chris doesn't pay them, the bondholders can sell all of his pizza ovens and any equipment to recoup the money they are owed. This claim on the business assets adds a layer of protection for the bondholder. If he doesn't like the idea of paying interest, he could issue ownership shares called stock. He doesn't have to pay stockholders interest, but they are entitled to their share of the profit that his business makes through what is called a dividend. The more profit he makes, the wealthier Chris and his stockholders will be. If his pizza business goes bankrupt, the stockholders could potentially lose all of their investment. This risk of complete loss is why stocks are more risky than bonds, but because stockholders share in the profit of the business, this gives them a higher upside potential on their money. So I hope Chris's story helps you remember the differences between stocks and bonds. So again, stocks, more aggressive investments, you're an owner in the company, so you have potentially unlimited upside because if the company does really well, you can make a lot of money. If the company goes bankrupt, you could lose all of your investment. Bonds, on the other side, safer investment. The company that is issuing you the bond has promised to pay you an interest rate. If they don't pay you that interest rate, you have the ability as bondholders to go and sell company assets to get the interest and the money that you've lent them back. So safer, less upside, but safer. Stocks, more upside, but a lot more risk. Hope that helps. Thanks for watching.